Welcome. My name is Kieran, I'm the Head of Aviation Advisory for KPMG, and welcome to another of our Aviation Leaders Report. I'm delighted today to be joined by Firoz Tarapore, the CEO of DAE Capital, and thanks as always to Airline Economics, who partner us in this. Firoz, thank you very much for joining us. Maybe just, even though everybody knows, but still be nice, give a little bit of background to DAE, if that's okay.
Sure. So DAE today is two things. One is a aircraft lessor, where we have a top 10 market position, where we have about 500 aircraft that we own and manage. And then we have our engineering business when we run our MRO services out of Amman, about 1,000 people, and about $100+ million of revenue from that business.
Wow. And maybe touching back to a topic that's very close to your heart, but I suppose what's your perspective on airlines and how they're performing across the various markets at the moment?
Right, so when we look at airline performance, we find that airlines kind of around the world are doing really well because the fare environment in which they are operating is a very, very favorable one. Now, sure, they have headwinds, they have costs that they got to deal with, fuel, etc., availability of people. But even within that, I think they've managed their environment in such a way that we see profitability emerging pretty much around the world. There are anecdotal instances where we will see an airline or two kind of not getting everything right and may report a loss. But in general, airline profitability has been emerging very nicely. And I think for us, it's a great thing to see, because that means that our clients are getting healthier, our clients are becoming more creditworthy, and within the context of that, it allows us greater comfort to kind of give them more credit, more aircraft, more leeway, and that's a good thing from our standpoint.
And maybe against that backdrop, are there any key concerns you have in relation to the macroeconomic environment or the geopolitical factors that are emerging, that have emerged?
So I think, look, the obvious ones are the big line items in the airline's cost statement, and I think most of them are manageable. Most of them, people have been around the block many times, so they know kind of how to deal with it. I think the one structural shift that we do see is the underlying trend in inflation and therefore wages. So, as we speak, the auto workers in the United States have negotiated a pay rise that nobody thought was likely to happen. It has the prospect of spreading to other industries, whether they're unionized or not, because otherwise, and you can see that non-unionized people are paying more just to avoid getting unionized, etc. So that's structural. So next time there is a demand downturn, this structural increase in operating cost is likely to create a more severe kind of impact. And we kind of keep an eye out for it because there's no going back on cost. It's up, it stays up, but demand kind of fluctuates in a very different way. So other than that, I think that the industry continues to remain fairly healthy. It is a shame that we are going through the engine shortage issues that we're going through, the supply chain issues, which is causing shortage on just the delivery of new aircraft, etc. But people are managing it in a mature way, and people are dealing with it. But structurally, we think that it's in quite a good shape.
And maybe touching on the engine issues, I suppose, how do you think that's impacting, in terms of airlines and lessors actually? Is it having a major impact?
I think from our standpoint, the issue around the Pratt & Whitney engine is a significant one because of the sheer number of aircraft that have to be taken out of service to fix the problem. Now, to the credit of the OEM, they've owned the problem, they've got a plan, they're fixing it. Is it fast enough? No. Is it good enough? No. But I think we're kind of getting there slower, but we're getting there. I think airlines have been given a planning horizon now, so they can plan to the extent that they can to get alternative capacity, extend their leases, do whatever they've got to do to deal with that shortage that they know, because that's better than having this uncertainty around, will my plane be flying, will my plane not be flying, et cetera, et cetera. And so I think, of course, it's a real issue. In the meantime, scarcity is impacting asset values, lease values, but there is a finite time horizon, and we hope that this time horizon will actually fix the problems as opposed to kind of this being a lingering issue that's going to continue on for too long. I mean, as it is, it's too late. It's 7 years on, but one hopes that this is the end, and kind of get on with a more reliable engine that goes along with the more efficient engine that it is.
Very good. And maybe I'd love to get your thoughts on aircraft supply, both in terms of, I suppose, deliveries in the secondary market and the impact that's having on asset values.
Asset values are higher. There's just no two ways about it. It's driven a little bit by inflation, because we see all these upward forces coming through the system in different ways. And also there is a general shortage. Both OEMs, Airbus and Boeing, have not been able to make their production numbers. That shortage is not likely to change anytime soon. So values continue to stay kind of fairly buoyant. That will, I think, persist. But it is a fair open question as to what happens when deliveries resume their normal schedule, because there is a significant refleeting underway, and when most airlines have done that, it remains to be seen kind of what happens to the valuation, if you will. I think everybody wants a cleaner solution. Everybody wants a more efficient solution. The new engines certainly provide that. But what happens once everybody has it, or a large majority has it? I think that's what we plan towards, to make sure that our risk around what's left is manageable within the context of where we are in the industry.
And maybe just thinking a little bit about some other factors that are impacted. So we've clearly had high interest rates, or at least in relation to the short to medium term, we've had higher interest rates. What impact do you think that's having, particularly on lease rate factors? Is that translating across?
So as you know, rates in the US have gone up by 525 basis points in the last 18 months or so. And what we see now is that our ability to pass along that increase on product that we are placing out of our own order book is quite good. It hasn't been that way. The lag has been a little bit and less than what it used to be. But I think that we are now at a point where we're not worrying about recovering our cost of funds, if you will. And we're making our funds, we're making our spread, we're making our normal profit. Where we see still a gap is on sale-leaseback activity as it relates to higher rated credits. There, I think our ability to pass along rates is not as evident as it is on the new order book side. On placements or purchase leasebacks with other credits, I think we're able to reflect our cost of funds in there as well. And I think it's a phenomenon that in this environment, people are willing to make the bet that the metal will ultimately provide a greater percentage of their returns than just an outright spread on their initial kind of lease rate, if you will. Only time will tell whether that bet pays off, but I think that we don't take that bet because we don't have the luxury of the balance sheet to do that. But nonetheless, we see that happening because these deals are getting done.
You mentioned cost of capital, and I wonder as well if you consider the debt markets at the minute, and maybe across three pillars, if that's okay. So we have capital markets, we have traditional aviation bank lenders, and we have a new cohort of deemed alternative lenders. How is that playing out for you? Do you think that's a benefit, or how is that looking at the moment?
Right, so I think I have to say that as we look back at this 3-year period, which I think one can objectively define as the most severe stress event that you can envision or design for our industry, that liquidity has performed phenomenally well. And it's a reflection of the fact that the business, the industry, has performed phenomenally well as well. So in this very difficult time, the top lessors have produced very consistent financial results, and financial results that reflect the balance sheet strength that they had going in, the liquidity strength that they had going in, and the underlying kind of franchise strength that we have. So capital markets, principally US capital markets, have remained open. What has also happened is that whilst a few conventional lenders have exited, in the banking industry, aviation as an asset class has kind of grown. So for example, we're based in Dubai, we are known in the region in a very different way. And when we see regional bank liquidity reflecting into us, the amount of money that they want to place with DAE as a credit, we see more and more banks that previously had not thought of this as a asset class, if you will, extending. So we see a lot of banks that had not participated in our segment now participating in our segment. And I think alt lenders, we will kind of see ultimately what will happen, because in all of that there's an arbitrage somewhere. So if you're relying on third party funding, which is pretty much markets, then you have to kind of define what the value proposition is in the middle. And I think it's a nascent one. Whether it'll survive the test of time, we're not quite sure. But in the banking business, we see aviation asset as something that is gaining more understanding, more acceptance, and therefore way more liquidity assigned to it.
And so that's alternative lenders on the debt side. But on the equity side, are you seeing newer types of investors coming into play in the space? And how did the asset class, do you think, compare to other asset classes? Notwithstanding, I'm asking an aviation person.
No, yeah. So, I mean, from a equity standpoint, we have the normal cast of characters that takes risk on the asset class through their investment in platforms. So we have people who accumulate up to 50 aircraft, for example, and then out it comes for sale, and there's a very defined return for the equity investor in that. And that model is kind of tried and tested. It's got a few people who have perfected it down to a science where you have a 2 or 3 year period, and then the risk is limited and you're out with a very decent product. I think the trend that we had begun to see from the financial investors who bought E-notes, so that's the equity paper in ABS transactions, that's the piece that dried up immediately after the pandemic and has not returned. And I would say that for me is a little bit of a mystery, because the buyers of this particular note were very sophisticated buyers. So buyers who understood what they were doing, who understood the risk, the potential returns, et cetera, et cetera. And because the shock to the system was, let's say, call it severe, they're the ones who've not been able to find a way to redeploy. It's ironic from my perspective, because redeployment in today's environment or in a pandemic environment may have meant more uncertainty, but there was clearly a reward for that uncertainty. The expected returns or the underwriting returns were at much higher levels, and for those people who wanted to kind of take that risk, take that exposure, the returns were there. It's ironic that no one has felt the compulsion or the need to kind of come up and do that. And a little bit, I think, has to do with the asset class, meaning too much volatility, but a little bit also has to do with the fact that there are so many more alternatives available today than when the interest rate environment was a little bit difficult. So think about it, people can make, or people had an expectation to make very high single-digit returns when the rate environment was half a percentage point to 1 percentage point. That rate environment is shifted up by 5.25, but expectations, equity return expectations have not shifted up by 5.25, shifted up. So I think the alternatives have become way more attractive, and maybe they've become attractive in such a way that like this is not a compulsion of people. Well, only time will tell when that group comes back.
And Firoz, maybe looking internally to the sector again a little bit, since the pandemic we've had clearly an upturn in the percentage of leased assets in typical airline fleets, and clearly the lessors were a big supporter of airlines during that time. But do you think that trend will continue for the medium term, that growth in percentage?
So lessors today have a very high percentage of the market, if you will. And one of the reasons, of course, is that during the pandemic, airlines were depleted of capital. They had losses, they had to cover all kinds of things. And it's natural when you lose 80, 90, even 100% of your revenue, and you have a cost base that's just structurally there, it's very difficult to kind of manage around it. And as their capital positions got depleted, I think it was natural for them to lean in on lessors to say, okay, fine, we'll use your balance sheet, we'll use your liquidity to help us at least keep our franchise alive and grow, et cetera, et cetera. So I think in that context, the lessor's share growing is not a surprise, because that's what you would expect to see. Going forward, we see now that airlines are building their capital. Profitability is very strong, but you need a multi-year performance for that to translate into, kind of deployable capital, if you will. So we're into, call it year 1 and a half of that. So if this continues on for another year and a half, 2 years, 3 years, we will see airlines flexing their capital muscle. And at that point, they will have many more choices. And in this interest environment and with new tech, they might decide to keep the metal exposure, they might decide to fund themselves, they might find themselves better rated, et cetera, et cetera. So it's a little bit unclear to us as to whether this is a structural change or a change that was necessitated by the marketplace. Either way, for us it doesn't make that much of a difference, because the pie keeps on growing. The pie is so large and it's becoming larger at a rate that allows us each to grow our value propositions without necessarily having to take market share away from the other. So I think for us it's academic. We are here to help our clients, and to that end, the discussion with our clients has changed. It has gone from a product-based discussion to a solutions-based discussion, because today they have need for engines, they have need for interim lift, they have a need for permanent fleet, they have all different kinds of things. And the more a partner can provide, I think the deeper the relationship that we can develop. We will see where this market share number ends up.
And DAE is no stranger to successful M&A, and scale has become important. Do you think scale will continue to be important, and do you think that will drive more M&A in the sector?
Scale is absolutely important. Scale is becoming more important by the day. So by way of comparison, if you look at the size of the 10th largest lessor 20 years ago, 10 years ago, and today, the trend is like this. And we don't think that that has stopped, because having that scale, again, allows us to have more of a relationship or a solutions-based discussion with our clients, and also gives us the opportunity to have different kind of discussion with each of our counterparts. And what the counterparts, like the OEMs, are willing to do for size is also changing. And what matters is now the depth of the relationship, the quality of the relationship, et cetera, et cetera. And all that gets better by scale. So I think scale is important. There is still potential left for the top 10 lessors to grow even larger by inorganic methods. Even organically, the order books are all stacked in the favor of top 10 lessors anyway, so they're going to grow without it. But inorganic growth is also going to play a large role, because there are still platforms that I think would benefit by being part of a much larger organization, where you can actually translate that advantage, that size advantage, into a better financial return.
And maybe just to kind of finish up, I might ask you about your outlook for the next 12 months and your level of optimism.
Our outlook for the next 12 months is very bright, in that we see all of the things that we've just discussed creating upward pressure on lease rentals, upward pressure on valuation of assets, et cetera, et cetera. What we kind of worry about is whether the geopolitical tensions that we see today remain contained or not. If they do not remain contained, I think there's a risk that we will have to deal with. But it's a known unknown, so we can plan for it to some extent within the context of an industry that is otherwise extremely strong. Not only is there a shortage, but there's also a refleeting that is driven by either sustainability goals or just pure economics, because the new engines will deliver 18-20% fuel efficiency relative to existing ones. So from that standpoint, we are super optimistic about what's going to happen, but we remain vigilant that there is a potential shock from things that we just can't control that we'd have to be mindful.
Firoz, thank you as always for your openness and your transparency and your insight. And I'd like to thank our partners, Airline Economics, for these sessions. So thank you.
Thank you, Kieran.